Okay, let's jump right in. We're doing a deep dive today into Norwood Financial, ticker NWFL, specifically their Q3 2025 earnings call.
Yeah.
This call happened pre-market, October 22nd. And look, it wasn't just, a modest beat. The market reacted really strongly. Big jump for the stock in one day.
It really did. That reaction, well, it tells you investors were listening closely. The feeling was definitely constructive, bullish even. So our job today is to figure out what exactly drove that feeling, what was the substance behind it. We need to look at how NWFL is handling this shift, the potential for lower rates and what it means for their margins.
Right. Let's start with the headline numbers because, wow, they really smashed expectations. GAAP earnings per share at 29 cents. But if you pull out the merger charges, which, are temporary, the adjusted EPS hit $1.94.
And you really need context for that. The street, They were expecting something like, 70, maybe 71 cents. So beating that by almost 24 cents. I mean, for a regional bank, that's absolutely enormous. It's not just noise. It suggests something fundamental shifted compared to what analysts thought.
Definitely. And revenue looked good, too. Came in at $22.96 million, also beat consensus. But the main engine behind that profit surprise, it really seems to be net interest income, the NII.
That's it.
We saw NII jump, 28% year over year?
Yeah.
From $15.9 million up to $20.5 million.
Yeah, that NII pop is really the heart of the story here. When you see that kind of immediate margin improvement, it's not usually just like a one-off fee thing. It signals real strength in how they're managing their assets and liabilities, earning more on loans, paying less on deposits. That's the game.
Okay, so let's dig into that margin specifically. The net interest margin, NI. That was the real story, wasn't it?
Absolutely. The NI fully tax equivalent, it landed at 3.63%. Management kept pointing to this, and for good reason. It was the core strength this quarter.
And in terms of momentum, what does that 3.63% tell us?
Well, it shows really significant momentum. It's up 20 basis points just from the last quarter, Q2. And year over year, a huge jump, 64 basis points. The CFO even broke it down, said that improvement alone added about $1.4 million to NII compared to Q2.
Wow.
And it wasn't just luck, right? They specifically tied this back to that bond portfolio repositioning they finished way back in December 2024.
Ah, right. I remember that.
Yeah, so they made a strategic move almost a year ago, optimizing assets, and now they're really reaping the benefits. Lower funding costs, better yields, smart planning paying off.
Makes sense. So they managed the asset side well.
Yeah.
But profitability also means keeping costs in check, right? Efficiency.
Yeah.
And they did well there too. The efficiency ratio improved dramatically, dropped almost 10 full points from last year, down to 56.3% from 66.0% in Q3 24. That's a big operational win.
Huge win. And that feeds right into another key metric we watch, pre-provision net revenue, PPNR.
Right. The core earnings power before loan loss provisions.
Yeah.
How did that look?
It looked strong. Adjusted PPNR came in at $10.60 million. Think of PPNR as, the bank's underlying profitability engine before accounting for credit risk. Seeing that adjusted PPNR jump 19% just from the previous quarter, that tells you they're not just growing revenue, they're running a much tighter ship operationally.
And can't forget the other income streams. Non-interest income was also up about 9% year over year, mostly driven by growth in their wealth and trust business. Good to see that diversification.
Definitely helps smooth things out. But look, great NII, great PPNR. None of it matters if the loans are going bad. So let's talk credit quality.
Yeah.
Management kept using the word benign. That's exactly what you want to hear right now. Credit quality remains stable, solid. And here's something interesting. They actually reported a positive allowance for credit losses release, about $500,000.
A release, meaning they took less provision.
Exactly. It happened because some larger loans that were previously non-accrual, meaning not paying, got moved back to accrual status. They cleaned up. So asset quality actually improved. And that helped push down the overall percentage of non-performing loans compared to last year. It just builds confidence in their risk management.
That solid foundation supports the growth we saw, too. Loans grew, 8.3% year over year to $1.815 billion. And deposits grew even faster, up 11.8% year over year, hitting $2.074 billion. So funding the growth.
Right, growing responsibly. And all this positive momentum pushed tangible book value per share up nicely, ended the quarter at $22.19. That's up $2.34 just since the start of the year.
Okay, so that's the snapshot of Q3. Strong quarter. But the stock reaction suggests the market was looking forward, right, at the guidance.
Precisely. Let's shift gears to the forward outlook, because that's where the real excitement came from. Management's guidance on future NIM expansion, that's the key lever everyone's watching. They're basically saying, look, we expect NIM to keep improving. Why? Because they anticipate being able to lower their deposit costs further, especially if or when market rates start coming down.
And they put a number on that sensitivity, didn't they? The deposit beta.
They did, and this is really crucial data. They estimated their deposit beta on the way down would be around 50%.
Okay, let's pause there. Deposit beta, for anyone listening, break that down. What does a 50% beta mean in practice?
Good question. So deposit beta tells you how much a bank's deposit costs change when market interest rates change. Let's say the Fed cuts rates by 1% or 100 basis points. If a bank has a 50% deposit beta on the way down, it means they expect to lower the rates they pay on deposits by about half of that Fed cut, so 50 basis points.
Okay.
A higher beta when rates are falling is good for the bank. It means they can reduce their interest expense quickly, which directly boosts their net interest margin.
Got it. And this ties directly into something specific about NWFL's deposit base, right? The municipal deposits.
Yes, this is like the secret sauce in their forward guidance. They hold a pretty big chunk, somewhere between $400 and $400 or $450 million in these municipal accounts.
And why are those different from, say, my savings account?
Because most consumer deposit rates change slowly. Banks might lag, people don't move money immediately, it depends on behavior. But municipal deposits, they're often structured differently. Many are tied directly to market rate indices. So when the Fed cuts, these deposit costs reprice almost automatically, very predictably.
So it's less about waiting for customers to react and more about structural repricing.
Exactly. NWFL doesn't have to rely solely on consumer inertia. They have this big pool of liabilities that will adjust downward quickly and reliably if rates fall. This makes that 50% deposit beta forecast much more certain for them compared to peers. It gives their NII projections real teeth in a falling rate scenario.
That's a significant structural advantage.
Yeah.
Okay, so beyond rates, there's another big thing happening. M&A. The deal to buy Presence Bank, PB Bank shares, announced back in July. How's that progressing?
Moving along, management confirmed all the regulatory filings are in. They expect it to close either late this year, Q4 2025, or maybe early next year, Q1 2026. And remember the numbers they put out before. They projected this deal would be about 10% accretive to earnings per share in 2026.
Right, and the earn back period on tangible book value is pretty quick too, right?
Yeah, about 2.5 years. Those are solid shareholder-friendly metrics for an acquisition like this. It looked like a smart, manageable addition.
And just quickly looping back to the operations side, the CEO seemed keen to connect these strong financial results back to their culture push, didn't he? That everyday better branding.
He did. He explicitly linked things like the tighter efficiency ratio and the higher fee income to that internal focus, and even cited their customer ratings average 4.7 stars. The argument is that culture and operational discipline aren't just soft stuff. They directly drive the bottom line, drive that PPNR growth we talked about.
So the whole picture is strong execution on the balance sheet, clean credit, driving efficiency, and a clear strategic path with M&A.
That's the narrative. And you put it in context, the broader regional bank sector, the KRE index, it's been lagging for months, but NWFL, it's actually outperformed its peers. They're really positioning themselves as a kind of textbook community bank focused on the right things, disciplined funding, smart M&A. They're clearly moving past that trough we saw in 2024 towards a model with higher returns.
Okay, perfect time to transition. As always, we're going to discuss some ideas based on everything we just heard. But please remember, this next part is strictly a thought exercise, educational purposes only. We are absolutely not providing financial advice or recommending you buy or sell anything, just exploring possibilities based on the data.
Right. Standard disclaimer applies. So if we were hypothetically putting on our analyst hats, pitching an idea based only on this call, the trade could be something like this. Initiate a tactical long position in NWFL now.
Okay, and the core thesis behind that hypothetical trade?
The thesis is pretty specific. It's that the market is currently underappreciating the certainty and speed of the margin benefit from that big block of municipal deposits, that $450 million pool.
And the catalyst you look for?
A single Fed rate cut. Just one 25 basis point cut in the near term.
Why is that single cut so pivotal for them specifically?
Because for NWFL, that cut isn't just a signal, it's a trigger. It should cause an immediate, almost guaranteed repricing downwards on that huge municipal deposit chunk. They should realize that 50% deposit beta much faster than peers who are waiting for consumer savings rates to drift lower.
So you're betting on the speed of that repricing being underestimated?
Exactly. And the projection would be that this faster repricing allows NWFL to hit, say, a 4% net interest margin much sooner than the market expects, maybe even blowing past their Q3 3.63% IMM quickly. Combine that accelerated margin expansion with the expected 10% earnings boost from the Presence Bank deal.
Yeah.
And you could see guidance for late 25 or early 26 get revised upwards significantly. It's a bet on the unique deposit mix acting as an acceleration engine in a falling rate environment.
Interesting. A very specific play tied directly to that funding structure advantage.
It is, and ultimately the whole story from this earnings call boils down to execution. Norwood seems to be executing really well on repositioning the bank. They're aiming for higher returns, better efficiency, and they have these clear catalysts ahead, integrating the Presence deal successfully and realizing those deposit cost savings as rates potentially shift.
Okay, a strong narrative indeed. So maybe a final thought for you, the listener, to chew on as we wrap up. Really consider how the type of deposits a bank holds municipal versus regular consumer accounts impacts its ability to manage its net interest margin when interest rates change. Compare NWFL's strategy, leveraging that structural repricing, against competitors who might be more reliant on slower consumer behavior. That difference in deposit mix could be key to understanding performance in the regional bank space going forward.